An important consideration when looking at the design of an insurance company, of course, is the question of who's actually in control, who holds authority over the allocations made by an insurance company. Strictly speaking, an insurance company has two major design possibilities. It can be either owned by its policyholders, what's called a mutualized insurance company, or it can be owned by outside shareholders, also known as a demutualized insurance company. Now, of course, ownership structure is important because it determines not only who keeps the profits from the operations, but also who takes the risks associated with the organization. This difference between mutualized and demutualized structures is very similar to the difference between a credit union and a bank. You'll recall that a credit union is owned by its members and makes loans to its members in the same way that a mutualized insurance company is owned by its policyholders and covers its policyholders. Meanwhile, a demutualized firm is a little bit closer to a bank. In a bank, the borrowers may or may not also be the lenders. And similarly, in a demutualized insurance company, the people who have policies may or may not actually be the shareholders of the insurance company itself. Interestingly enough, we've seen a recent wave of demutualizations across the North American insurance industry, driven largely by the desire of firms to be able to grow their asset base through additional equity offerings rather than having to organically grow through expanded membership. In the mid-20th century, actually, a number of Canadian life insurance companies who feared that they might be acquired by foreign competitors actually went through a process of mutualization, moving in the opposite direction from being shareholder-controlled firms to being controlled by their policyholders as a way of preventing a hostile takeover. When the concerns around this passed, ultimately, we saw Canadian firms demutualize once again. So there are some trends in mutualization and demutualization, but in the 21st century, we've largely seen a trend towards demutualization. Now, this has raised some interesting debates regarding certain kinds of insurances that people buy from their companies. For instance, when we take a look at US health insurers, one of the areas where there's been concern about the process of demutualization in particular is largely rooted in the notion that shareholders are much more interested in growth and profit, whereas in a mutualized health insurance company, the owners of the firm, those who are covered by its products, are much more concerned about affordability and achieving dividend growth for themselves. So you see a slight difference between the incentives of the owners and what that can lead to in terms of how the firm adjusts its policies and allocates its portfolio. Now, there are a couple of specialty sorts of insurance companies. For instance, one of the particular designs we see is what we call a reciprocal insurance pool. And a reciprocal insurance pool is very similar to a mutualized insurance company, but with one key difference. In a mutualized insurance company, the owners have contributed a particular amount of capital, which will be drawn down in the event that there are significant claims against the firm. However, there is a limit to the amount of capital that is available to meet claims. In a reciprocal pool, however, there are no limits to the size of claims that can be brought against the pool, which means that certain kinds of risks which have extraordinarily large potential payouts might not be appropriate to cover using a mutualized insurance pool that has a limited amount of coverage available. So, for instance, we see medical malpractice insurance pools in the United States being organized in this particular way. Farmers also use this kind of mutualized insurance as well. The idea, of course, being that they are willing to stand with one another in order to safeguard against losses in unlimited amounts. Finally, we have a relatively new innovation from the 1980s called a captive insurance company. And a captive insurance company is what happens when a firm creates an insurance company to insure its own products that is wholly owned by the insured. In other words, the company creates an insurance company for itself. Usually, these kinds of organizations are designed when a firm is worried about releasing failure rate data to an outside party. For instance, we might note that certain kinds of manufacturers prefer to self-insure rather than releasing failure rates to outside organizations. So this allows firms who are uncomfortable with sharing details of their organization to ultimately still offer an insured product to people. So it's worth considering what the implications are for all of these different kinds of structures. We have captive insurance companies that are owned directly by the firms themselves who are seeking their own insurance. And this is largely done to keep down their costs and to maintain their secrecy. We also have reciprocal insurance pools, which are effectively mutualized pools, but with unlimited liability, effectively for any claims that might be brought. And of course, we have the possibility of a demutualized insurance company, whereby outsiders control the firm and are the ones who are subject to risk, unlike a mutualized or a reciprocal insurance pool.